welcome to today's explainer. Right now, almost everyone is debating whether AI is just another massive stock market bubble. But what if I told you they're looking at this from completely the wrong angle? Today, we're going to look beneath the surface of all these wild tech stock swings to uncover the invisible financial mechanics actually driving this market. Specifically, we're zeroing in on a staggering hidden liability right at the center of the AI boom. It's super common to compare today's AI-driven frenzy to the dot-com crash of 2000. But here's the thing. The dot-com crash was fundamentally an equity bubble. It was basically gamblers losing their own money in the stock market. What the AI trade has morphed into is entirely different. It's a massive, interconnected debt bubble. And that is a huge distinction because the fallout from a debt bubble definitely doesn't stay neatly contained to just the stock market.
Section 1. The math problem. Massive commitments versus cash burn.
Okay, before we can wrap our heads around this systemic risk here, we really have to break down the jaw-dropping numbers underlying the AI space. Let's focus on the biggest player in the room, OpenAI. Consider these figures. OpenAI has planned compute spending that hits roughly $750 billion through 2030. $750 billion. We're talking a $300 billion 5-year cloud deal with Oracle, a $250 billion commitment to Microsoft Azure, and a custom silicon program with Broadcom that could easily hit anywhere from $100 to $350 billion all on its own. The sheer scale of these commitments is literally breathtaking, and it just shows how heavily this entire AI trade relies on these colossal and honestly, sometimes highly uncertain figures.
But here is where the math problem really starts to rear its head. When you stack those hundreds of billions in commitments against OpenAI's actual financials, well, things look severely mismatched. In the first quarter of 2026, they pulled in $5.7 billion in revenue, but they burned $3.7 billion doing it. Think about that for a second. Their operating margin is effectively negative 122%, so they are spending $1.22 just to make a single dollar. Oh, and their audited yearly loss for 2025? A staggering $20.9 billion.
This leads us to the absolutely crucial question of this whole explainer. How exactly does a company losing roughly $20 billion a year manage to sign contracts and fund obligations that work out to around $200 billion annually? If the organic revenue is nowhere near enough to support the spending, who is actually lending them the cash to keep the lights on?
Section 2. The linchpin. NVIDIA's invisible debt guarantees.
That brings us to the absolute linchpin of this entire operation. We really need to talk about NVIDIA. We're not just looking at them as a hardware supplier today, but as a massive, hidden financial backstop for the entire industry. Just let this number sink in for a moment. $600 billion. NVIDIA is reportedly in talks to guarantee roughly $250 billion in lease and construction debt just for a data center campus. On top of that, they're discussing financing up to $350 billion more for OpenAI's actual chip purchases. That puts NVIDIA's potential exposure to just one single money-losing customer at nearly $600 billion.
What we're looking at here is a brilliantly complex loop of circular financing. Let's break it down step by step. Step 1. OpenAI desperately needs chips, but they don't have an investment-grade credit rating. Step 2. Because of that, traditional lenders flat out refuse to underwrite that risk directly. Step 3. NVIDIA steps in and essentially guarantees the debt, which suddenly makes those lenders comfortable enough to open their checkbooks. Step 4. The money flows, and NVIDIA gets to book a massive, record-breaking hardware sale. So they've effectively morphed into a lender just to bankroll their own astronomical sales figures.
But here's the crazy part. Notice the massive discrepancy in what's actually being reported. NVIDIA's official quarterly filings cap their total disclosed lease guarantee exposure at a mere $3.5 billion. Yet behind the scenes, we're talking about estimated commitments that are roughly 71 times larger than what they publicly disclose. And the market is starting to notice. Because of this rising invisible risk, the cost to insure against NVIDIA defaulting, which is known as their credit default swap spread, recently jumped the most on record.
As the legendary investor Michael Burry perfectly summed up this dizzying circular debt loop, around and around we go. It is essentially a giant house of cards built on vendor financing. And the scariest part, if we look back at history, we've actually seen this exact movie before.
Section 3. Echoes of 2000. The danger of vendor financing. Let's take a quick trip back in time.
The equity bubble of the dot-com era usually gets all the spotlight. But what really decimated the tech suppliers of that generation was actually aggressive vendor financing, which is exactly what we just outlined with NVIDIA. Back in the year 2000, a telecom supplier named Lucent Technologies committed about $8.1 billion in customer financing and loan guarantees. Well, when their customers, like a telecom firm called Windstar, went bankrupt, Lucent was left holding the bag. They had to take massive debt provisions in 2001 and again in 2002. By 2006, Lucent's revenue had completely crashed from $38 billion down to just $8 billion. They only avoided outright bankruptcy by selling themselves off.
Now, I want you to compare the scale here. Lucent's fatal commitments back then equaled roughly 24% of its revenue. Today, NVIDIA is discussing a $600 billion exposure that utterly dwarfs its entire $215 billion annual revenue. To put that into perspective, the scale of NVIDIA's hidden liability today makes the financing that nearly destroyed Lucent look like absolute pocket change.
Section 4. Accounting illusions. Hiding behind depreciation. So if the suppliers are taking on massive risk to fund these startups, what about the hyperscalers? You know, the giant tech companies that are actually buying the bulk of these chips? Well, it all comes down to an accounting trick called depreciation. Simply put, depreciation is an accounting rule that lets you spread the cost of an asset over the years you expect to use it. But here's the magic trick they're pulling. If you artificially stretch out the expected lifespan of your servers, your reported profit magically goes up, and you don't even have to change a single thing in the real world to do it.
Just consider what the biggest companies in the world are doing right now. Alphabet extended their server life to 6 years, which instantly added $3 billion to their net income. Meta stretched theirs to 5.5 years, magically cutting their expected depreciation by $2.9 billion. Amazon extended theirs to 6 years, booked a huge gain, but then actually had to reverse course back to 5 years. Why? Because the rapid pace of AI development made those servers obsolete faster than expected, which ended up costing them $700 million in operating income. Keep in mind, NVIDIA ships brand new, totally obsolete making chip architectures every 12 to 18 months. Claiming these servers will stay relevant for 6 full years is a massive stretch, and it's inflating industry profits by roughly 20%.
Now, defenders of this practice will say, hey, depreciation doesn't impact cash flow, but let's actually talk about their cash. Despite generating unbelievable amounts of cash flow, these giants are still outspending what they bring in. In a recent quarter, Amazon generated $45.4 billion in operating cash flow, but they spent $54.2 billion on CapEx. Alphabet generated $39.1 billion, but spent $44.9 billion. The reality here is undeniable. The marginal dollar of AI spending across the board is a borrowed dollar.
Section 5. The ocean floor. A systemic global credit risk.
Guys, this is no longer just an isolated tech issue. We are looking at a systemic global risk. $1.65 trillion. That is the staggering estimate of off-balance sheet debt sitting across big tech right now. It's largely made up of long-term data center leases. This hidden debt load has ballooned, growing roughly 8 times larger in just 4 years. And this debt isn't staying safely quarantined out in Silicon Valley. Oracle was recently downgraded by S&P to BBB-, which is just one single notch above junk status, specifically because of their massive OpenAI exposure. Meanwhile, Wall Street banks are currently syndicating a $35 billion GPU-backed debt facility. They're slicing up this tech debt and distributing it all over the place to insurers, credit funds, and structured vehicles. This matters to all of us, because a failure in tech wouldn't just wipe out tech shareholders anymore, it is a systemic credit disaster just waiting to happen.
If you want a real-world example of what happens when highly confident, leveraged AI enthusiasm abruptly reverses, just consider South Korea. Over there, record retail margin debt fueled a massive AI surge in the Kospi index. But when that trade finally unraveled, it triggered over 1.2 million margin calls. It forcibly liquidated hundreds of thousands of accounts and caused the absolute worst month in the index's entire history. And remember, that leverage was retail-driven and clearly visible. Our current AI debt is institutional, deeply intertwined, and mostly invisible off the balance sheet, which makes it arguably much, much worse.
So, I want to leave you with this final thought. Right now, we are looking at a market that is fundamentally mistaking staggering leverage for staggering genius. With NVIDIA holding a potential $600 billion hidden liability just to prop up its own loss-making customers, you really have to ask yourself, is AI set to trigger an unprecedented global credit collapse, or will it somehow grow fast enough to deliver on its promise and outrun this colossal house of cards? Thank you so much for joining me for this explainer. Keep asking the hard questions, and I'll see you next time.